Mastering Risk Analysis in Investment Decisions. Welcome to Finance Unlocked, your go-to podcast for unraveling complex financial concepts into practical strategies. I'm your host, Juan Manuel Mendoza-Puccini, and today, we're diving into a crucial topic for any investor: analyzing risk in investment decisions. Buckle up, because we're about to make risk analysis crystal clear. Segment 1. Understanding risk in investing. When we talk about investing, the word risk often steals the show. But what does it actually mean? Risk is essentially the uncertainty around your investment returns. Will your investment perform as expected, or will it fall short, or worse, result in a loss? Let's break it down into three key types of risk. 1. Market risk. Think of this as the roller coaster of stock prices or bond values due to economic events, political changes, or natural disasters. For instance, in 2008, global markets plunged due to the financial crisis, showcasing extreme market risk. 2. Credit risk. This is relevant when lending money. Will the borrower repay as promised? Corporate bonds, for instance, carry credit risk depending on the issuer's financial health. 3. Liquidity risk. Imagine owning a luxury car you can't sell quickly during a cash crunch. Liquidity risk works the same way in investments. Assets like real estate might take time to convert to cash. Segment 2. How risk impacts returns. Why does risk matter so much? It's because risk and return go hand in hand. Higher risks often promise higher rewards, but they also come with a greater chance of loss. Let's use a quick analogy. Picture two runners. One sprints fast but often trips, high risk, high return, while the other runs steadily without tripping, low risk, lower return. As an investor, you're choosing between these runners based on your goals and risk tolerance. In finance, we often use the risk-return trade-off to measure how much risk is acceptable for a given level of return. Chapter 8 of Higgins' book discusses tools like variance and standard deviation, which quantify how much an investment's returns deviate from the average. For example, if a stock's return fluctuates wildly, its standard deviation is high, signaling more risk. On the flip side, stable returns indicate lower risk. Segment 3. Tools to measure and manage risk. Now let's get into the toolbox for risk management. Here are three key techniques every investor should know. 1. Diversification. This is the classic, don't put all your eggs in one basket. By spreading investments across asset classes, industries, or geographies, you reduce the impact of any single risk. Think of it like having a backup plan. If one investment underperforms, others may balance the scales. 2. Beta analysis. Beta measures how an investment moves compared to the market. A beta greater than 1 means more volatility. Less than 1 means less volatility. If you're risk-averse, you might lean toward low beta investments. 3. Scenario analysis and stress testing. What if the market drops by 20%? Scenario analysis helps simulate outcomes under various conditions. Stress testing pushes this further, asking, what's the worst that could happen, and can I handle it? Lastly, tools like Value at Risk (VAR) estimate potential losses within a set time frame. For example, a VAR of $1,000 at 95% confidence means there's a 5% chance you could lose more than $1,000. Segment 4. Putting it all together. To make informed investment decisions, always align your risk tolerance with your financial goals. If you're planning for retirement decades from now, you might accept higher risk for potential growth. But if you need funds in the next few years, lower risk investments like bonds may be better suited. And don't forget, risk is dynamic. Monitor and adjust your portfolio as circumstances change. As Robert Higgins emphasizes, successful investing is about balancing the risks you can control with the rewards you seek. Conclusion. And that's a wrap on today's episode of Finance Unlocked. We've explored the types of risk, their impact on returns, and the tools to manage them. I hope you feel more confident in navigating the fascinating and sometimes nerve-wracking world of investing. If you enjoyed this episode, don't forget to subscribe and share it with a friend. Have a topic you'd like us to cover? Drop me a message. Until next time, keep learning, stay curious, and make smart financial moves.